We heard before the break from Ilya, who's going to come back in a minute, around the whole working capital conversation. We're now going to hear from another friend of mine, Edwin, who I'm afraid another British-sounding person, I'm afraid. I'm going to talk a bit about another aspect of it, which is around trade finance, particularly in emerging markets, which I think is fascinating. And Edwin's outfit, Aztec, is really, really a trailblazer in this area. So we're going to hear another insight into the whole working capital trade finance opportunity. So without any further ado, I'm going to ask Edwin to come up on the stage and talk us through what Aztec are up to. Edwin, that's all yours.
Thank you very much. So Aztec Exchange is a global trade receivables platform. And as you've heard from the previous speaker, Ilya, at Market Invoice, this is a segment that has exceptional growth and exceptional scale. What is a little bit different about what Aztec does is to imagine the following. Our primary aim is to fund the suppliers in the Nestlé supply chain. So we're talking about the cocoa farmer in Ghana who sells cocoa to Nestlé. Our aim is to provide trade finance to that guy. And let's be quite specific here. We are not a lending outfit. Unlike a lot of the guys you see here today who lend or are recourse-based, we are a non-recourse-based platform. In all intents and purposes, an investor, an institutional investor, acquires the invoice from the Ghanaian cocoa grower. And that's quite an important point to understand because it means that implicitly you are taking risk on Nestlé and you are earning Ghanaian unsecured credit yields without taking risk on the Ghanaian farmer. And our aim, effectively, to understand what it is we do, is to do that in scale. And let's just really take a look at what it is we're talking about. To put it simply, we originate receivables from the countries that are not green, and we take risk on the corporate debtors in the countries that are green. So you have to imagine whether it's Del Monte, Whole Foods, Gap, J. Crew, we fund the suppliers in the Philippines, Vietnam, Sri Lanka, Bangladesh. And effectively, those guys in Bangladesh, they get unsecured credit at maybe 65, 70%. On our platform, they can come along and sell an invoice at 2% per month discount rate. The institutional investor gets to earn a return on GAP of 24% annualized, taking GAP risk. What's important here to understand is that when we started this business, like many of the platforms here, we went invoice by invoice, supplier by supplier, SME by SME, and that's great to prove a concept. But what you want to do, you want to be doing 50 billion, 100 billion. So the next stage is you go to the corporates, and you say to Whole Foods, you have a bunch of suppliers in Costa Rica, in Ecuador, Guatemala. They are not getting funding from your bank, from Bank of America, your banking partner. What we want to do is we want to get PIMCO, BlackRock, Fidelity in the room to fund these Costa Rican and Guatemalan suppliers on a true sale basis. You have to remember that because we don't have to do the credit analysis on the supplier, the invoices are sold on a true sale basis. Effectively, you want to take as much risk on Whole Foods as you can. More importantly, if Whole Foods are going to confirm the invoice and agree that there'll be no disputes, you want to put this thing on steroids. And that's effectively what we do. We are the platform that allows institutional capital to get into the trade finance space in scale while anchoring their corporate credit risk on a specific obligor. Now, this gets interesting when you turn around to Gap or Coca-Cola's Treasury Department and say, listen, we're going to set up a fund. And what we want you to do is we want you to take risk on yourself, earning 20% a year yields. So we're talking about the Treasury Department of a corporate entity funding an SPV with institutional investors that buys invoices on a true sale basis from emerging market suppliers. Now, if you're a CFO, you're asking yourself, what is your Treasury Department doing buying the S&P or US Treasuries when they could be buying risk against themselves and earning 10, 15, 20%? That's what we do. I wish I could tell you there was more to it, but there isn't. That's straightforward. Typically, in any supply chain, whether it's Ford, Coca-Cola, Walmart, the banks like the top 20% because they lend money to them. That's a recourse model. So when Unilever supplies products to Target, Bank of America or Citigroup want to give them a letter of credit or a factoring line. What I'd like to do is I'd like to fund the bottom 50% of suppliers against Target. And you see, because I don't have to do credit analysis on these guys, I just have to acquire their invoice. Target approves and validates these invoices, so I want to do as much of that in scale as possible. The great thing is, there's something, any of you who ever meet a banker, say Mozambique or Yemen, and see what the look on their face is. When we're out in Philippines, we don't come across Citigroup bankers. We're out in Ghana, we don't come across the bankers. Yet if you look at the back of your T-shirt, the back of your cocoa bottle, the back of whatever, trust me, they're not made in Delaware. There is a $14 trillion market in global trade. $5 trillion of it is funded by banks and factoring companies. We are the only player in the $9 trillion space. We are the only guys in Ghana originating receivables in the Nestlé supply chain, the only guys in Uruguay originating receivables against Louis Dreyfus, and so on, and so on, and so on. And I could be the stupidest guy in the world, but in a $9 trillion market, even if I trip over and fall, we're going to do pretty well. And I think that's the important thing to understand, that, again, you want to fund as much of Nestlé's supply chain from Angolan suppliers as possible, as long as Nestlé is confirming the invoices and offering you a dispute-free investment. You don't have to do the credit research on the Angolan farmer. It's not relevant. We want to talk about the altruistic side of this. The only way you're going to get capital to start funding the emerging portions of supply chains is through processes like this. There is no other way that you can get capital into those markets on a recourse basis. You don't want to be lending money to Ghanaian farmers. The point here is to be acquiring their invoices on a true sale basis in scale. The critical point here is that, indeed, there is a huge market for SME financing. There is a gigantic market for emerging market SME financing. But this is about scale. How do you get scale? How do you get the biggest portion of that $9 trillion that you can? And you have to do that with the cooperation of the corporates. You have to give them a vested interest to fund the bottom part of that supply chain. And you've got to make the economic return suit all parties. The problems that we face today are not conceptual. We've proved the concept, we've done the SME funding stuff, so on and so forth. The point now is to make the banks and the corporates understand that platforms like ours are collaborative. If you are a bank anywhere, just to use Citigroup as an example, if you fund the top 20% of that supply chain, that's your corporate bank doing that. There is no reason why your capital markets division shouldn't fund the other 80% and distribute those notes to private wealth, private banking clients, and institutional investors. The key issue today is they don't have the platform to originate that stuff. That's what we do. So the future isn't necessarily, when we talk about bank disintermediation, banks are willing to disintermediate themselves to a point as long as you're going to be of assistance. And I think that the future for some of our platforms, some of the platforms you've seen here today, is scaling through collaboration. There's only so far you're going to go fighting SME by SME. It's fantastic and it's a great business, but the reality is at some point you want to be acquiring 1,000, 2,000, 3,000 SMEs a day, and the only way you're going to do that is with collaboration with the banks and the corporates. Our platform is multilingual, runs in 22 languages, is self-service, self-origination. We bring Silicon Valley to West Africa. We bring Silicon Valley to Indonesia and to everywhere else. Our platform is available on mobile, and it's available 24 hours a day, anywhere you are. To really think about what it is we do, we have moved on from invoice-driven single SME financing to effectively supply chain financing. What we want to do is to get large institutional investors to fund multi-billion-dollar parts of a specific supply chain. I think that if you ask me tomorrow where the future of our space is, I think that implicitly there is going to come a point where your institutional investors effectively are the ones that own platforms like ours. PIMCO has capital, BlackRock has capital. The one thing they don't have is origination capability. Structuring an SPV is not difficult. There's no reason why net, the very large institutional players out there simply don't acquire origination competency and put this stuff on steroids. Because at the moment, there are platforms like Market Invoice, like Aztec, Receivables Exchange. We do a great job of originating. We do a great job of aggregating. There are banks out there who have salesmen who will structure an SPV and issue you or distribute the notes to the institutional investor. And again, I think that's great. But the point is, if I'm running a large institutional house, I ask a very serious question, can't I just do this myself? And I think the future for a lot of the platforms in our space, and maybe for some of the platforms outside, is that at some point, it is your very large institutional investor that steps in and puts these things on steroids. And really, for them, it's about scalability and about ownership. So today, the smaller scale institutional model, the single, whether it's lender or SME model, is interesting. But to take it to the next stage, we need to stand on the shoulder of giants. And whether those be the corporates or the banks, I suspect that's the way it's going to go. Thank you very much.